All right, welcome to our Finance Friday weekly course. I am Jerry Fetta, owner, founder, CEO of Wealth DynamX, and we are coming to you once again with another great course today on financial calendar dates, right? And we've been doing these courses for several years, and the goal and the purpose for me of doing this every weekend is financial literacy, okay? It's important to me that you guys know this information, that you're able to apply it, because my life got easier when I started to realize and learn this stuff. Okay. I saw a great quote today. I forget who it was from. Maybe it was yesterday, but basically it was saying that you can't be wealthy if you're financially illiterate, right? Like no matter how much money you have, no matter how much assets you have, no matter how much you have in passive income, if you're financially illiterate, you're not wealthy. Okay. And I'm sure we've all seen examples of that in life. And so my goal is to help you build wealth and build solvency, but to do that through financial literacy. Knowledge is power. It's something that can never be taken away. Inflation can't destroy it. And it's something that gives you control, because everything in our lives somehow is involved with money and finance, whether we want to acknowledge that or not. Okay. So it's important that we acknowledge it because it's real. And if it's not something we acknowledge, it literally is like being in this giant current, and it's pulling us downstream the entire time, and we're acting like nothing is changing, but in reality everything is. And when we try and get out of the water, if we even can, we're going to get out somewhere different than we got in, and we're not going to recognize the scenery around us, or we're going to be lost. And that's what happens with finances. So with my course tonight, it's called the financial calendar, right? And it's perfectly fitting. And the reason why is because we're heading into the holiday season, right? We have Halloween coming up. We have Thanksgiving coming up. We've got the Christmas season coming up. We've got New Year's coming up. And it's kind of that corridor of just boom, 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 one holiday after the other. And we get really caught up in that. But what I like to point out, and what I'll point out tonight, is this same period of time is probably the most busy period of time financially. It's when you should be the most engaged with your finances. And a lot of Americans aren't, because we're focused on all these other holidays. And I'm not saying don't focus on them and don't celebrate them, but I'm saying be aware. That's the point of the course tonight. Okay. So before we dive into the main thing here, I want to go over my ground rules. I cover these every week. Number one, have a purpose for being here. I want you to think about, why are you here? We're talking about, again, the financial calendar, right? And so I want you to think about how you're going to apply this information. How does this impact you? And what is your goal? And what are you going to do with it? Because without that, there's no reason to be here tonight. You can tune off and go watch Netflix, or go play patty cake, or whatever it is you want to do with your Friday night. But this is something that it has to be applied, right? Second thing is, nobody knows everything. So get rid of the idea that I've heard this before, I know this already, this is something I don't need review on. Number one, nobody knows everything. Everyone can learn something tonight, as long as they've got the attitude and the purpose. And then number two, even if you do know this stuff, repetition equals certainty. The more times you do something, the more certain you are. The more times you hear something, the more certain you are. Right? There's not one skill in your entire life that you did once and you were world class at because you did once. Right? So this is education, and education is not something that is done as a single event. It's something that you do as a consistent application. Okay. I still learn this stuff. I still review it. And I'm where I'm at already in life. And it's not something where I feel like I don't have to, because I've achieved already what I wanted to, right? There's more to go, and there's more to learn. And then the next thing is, obviously, be positive, be a producer. So I want you to take your consumer hat off, right? I know we live in America, and that's hard to do sometimes, but take the consumer hat off, and I want you to put the producer hat on. We're not here tonight to consume and take and not do anything with it. We're here to freaking burn financial calories. This is an active course. So I want you to think about how you can contribute, how you can ask questions. Like I said, how you can apply the information. And if something doesn't make sense, I want you asking, hey, what does that mean? All of this stuff tonight, like I talk about, money is vocabulary and arithmetic. So it's, the words we use in the basic math that we learn in school. A lot of this tonight is dates. So there's going to be, what I would say, in lieu of planning, memorization. You're gonna have to know these dates. Otherwise, you've got to really note take and keep them in a binder or a journal or a calendar or on your iPhone or whatever it might be. Okay. So that's what I want to cover tonight. Now, the idea of a financial calendar, like if you think about a calendar, we've had calendars since the beginning of time, right? Like you can go back to the most ancient times and you can find out that they had calendar systems. It might not be the calendar system we're used to, but they all had them, which tells us that at every point in time, the human race, the idea was that a calendar was smart, right? It's a good idea to have a calendar. It's a good idea to have a predictable, consistent, accurate, and simple way to track things, because it is the same stuff over and over. It happens in seasons. Okay, we're going to talk about some seasons tonight, but if you don't have a calendar and you don't realize that, A, this can be tracked, then life's going to be a lot harder than it needs to. And B, you're not going to be able to keep track of anyone else. The other people that build wealth, me, other top 1%ers, we use this calendar system. We mark these dates. We know what they are. We plan for them. And so if you're like, man, I want to be financially independent, I want to build wealth, I want to be financially free, but it goes back to illiterate. I'm completely illiterate on any of the important dates. Like, you're not going to be able to communicate with those that are paying attention to it. Okay. And you're always going to be in mystery on like, well, what season's coming next? Well, if you had a calendar, you would know it's autumn. And after autumn is winter, and after that is spring. And it wouldn't be a surprise to you when after the summertime, it gets cold and you're like, man, how do I survive? You'd be like, oh, winter's coming. I need to plan for it. Okay. So the financial calendar. Now, what is the purpose of having a financial calendar? That's what I want to go over first tonight. Okay. The purpose of actually having something like this. So the purpose is an organized and on-time financial implementation. So two things: organized and on time, right? We want to be organized with our finances. We want to be on time with our finances. And so the way that we're going to do that is by following a calendar, right? Like I said, same reason you would follow a calendar with your holidays. You want to be organized with them. You don't want to forget Christmas and birthdays and important federal holidays and school days and all this other stuff. You don't want to forget your own personal appointments. You don't want to forget your business meetings. So you would put them on a calendar so that you can be organized and so that you can be on time and so that you can actually attend and implement those things. So finances is no different, right? And I would venture to guess that probably 90% of us watching right now aren't doing this, right? We're not paying attention these days. If you are, like, congratulations to you. That's awesome. But for the average person, like most of us don't. We remember it's tax season because we see, an H&R Block commercial, right? We remember that it's open enrollment because all of a sudden we start getting letters in the mail from all of our insurance carriers, right? So we remember it's W-2 season because we start getting them in the mail. But the difference there is we're being advertised to. When I see a commercial on TV for H&R Block and I'm like, oh, it's tax season, I should start thinking about taxes, I'm doing that from the hat of a consumer. H&R Block is advertising to me on TV because they want me to buy their product, not because they want me to be proactive with my finances, not because they're trying to help me build wealth, not because they care about me. It's because that's their product, right? And so another mindset is we can treat this one of two ways. We can treat this like all the other holidays where we get advertised to and we get promoted to and we get marketed to, and we do it because of the marketing. Right? We go buy a crap ton of shitty Halloween candy because we walk into the store, the grocery store, and it's plastered all over everything as soon as we walk in the door, and we get marketed to, and we're like, oh yeah, I should buy some nasty Snickers, right? Or with any other holiday like that, we get marketed to. You can do that, and that's the effect route. I'm the effect. I'm the one being advertised to. I'm the one that's in the passenger seat. Okay, or I see some angry faces at the nasty Snickers. Guys, we got to upgrade our chocolates. That's a different conversation. We got to upgrade our chocolate quality. Snickers ain't chocolate. And I can tell you that I grew up in the sticks, right? I'm a redneck at heart. I grew up on Snickers. I've had better, and I'm telling you there is better. So I want to share that gospel with you tonight as well. But the second hat that we can wear is, again, the producer hat. Like, I don't do these things because I'm being advertised to. I'm not doing these things simply because I'm a consumer. I'm doing these things because they matter. And I have goals and I have purposes. And so I'm intentional with my time and my schedule to proactively think ahead, right? Like the word intention, when I intend something, right, means I'm putting my focus on it into the future. It's not a past thing. I can't intend something for the past. So if I'm putting my intention on, okay, I want to lower my tax bill, it's important that I know all the dates. If I'm putting my intention on, hey, I want to pay less for health insurance, it's important that I know the dates. If I'm putting my intention on, hey, I want to plan out my year, it's important that I know the dates. Okay. So without further ado, I'm going to jump into some of these dates. I'm going to talk about this in the standpoint of the actual dates. And then I want to talk about just the flow of it as seasons and why they're set up the way they are, and how you can really take all of these very, detail oriented dates, and it's very, minutia, and take it and make it more of just a flow. And you can automate the reminders and all the stuff, but for sure, like, where you're going or what the track is. Okay. It's kind of like being in the current in the river. Like I said, you can pay attention to every single tree and be like, that's a tree. And that's a lot of minutia and detail orientedness and a lot of stuff that you're going to put a lot of attention on, but it might not pay off. right? Just like the dates. The dates are arbitrary. Someone made them all up. Someone said, we're going to pick April 15th. That's the date. Why? I don't know. That's the date they picked. Okay. That's just a tree. You can automate all that, right? But you need to know what direction you're going. If you're in the river and you know the current's going this way and I'm trying to go this way with it, I can start to navigate in front of me instead of being like tree, 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 and not focusing on anything out in front. Okay. So first date that I want to cover is actually December 1st. My year begins on December 1st, not January 1st, right? And the reason for that is by December 1st, like a couple of things happen, right? So let's take this year, for example, 2021. December 1st rolls around. Everything I'm going to be doing for the 2021 year, I want that to be done by December 1st, right? Number one, like growing into December, I already know it's Christmas, it's New Year's, it's the holiday season. I don't want to have all this stuff on my back on like, oh crap, I need to plan for this. I need to open up this account. I need to fund this. I want all of that done by December 1st. So I can just enjoy my holiday season. Who's all for that? Like enjoying Christmas with your family, enjoying New Year's with your family, going on a trip, going on a vacation, whatever you're going to do. And we know we're going to do it for the holidays, just being able to be there and be present and not doing out of ignorance because you're like, oh, I didn't think about any of this stuff and I'm not going to, and I'm going to be complete effect and be surprised next year when I didn't plan ahead. We're not saying that. We're saying, no. All this is planned for and done by December 1st. Okay. So by December 1st, I am goal setting for the coming year. I'm not doing this on January 1st or December 31st where I'm sitting down and, I'm doing my New Year's resolutions because that's what everyone should do. No, I'm doing that on December 1st. When I take my time with my family, we're going to plan out next year a little bit. Okay. First thing that this does, who likes to go on a trip for Christmas or New Year's, like a week or two where you leave, you maybe go to Aspen or you go to the Caribbean or you go wherever, but you're going to go on some kind of holiday trip. Okay. Who does that? I know a lot of people do that. How would you like to be able to write that trip off on your taxes? Right? That would be great. Nano says Girdwood, Alaska. Okay. So you can write the trip off on your taxes if, number one, you have a family management company. Okay. And that family management company is in charge of planning out your year. And then when you go on a trip, you spend 4 hours a day, the entire time you're there with your family, talking about your goals, right? Planning ahead, doing some strategy. And if you do that 4 hours a day, that trip is now a business trip and it becomes tax deductible, right? So your Christmas trip, whatever you spend, you're about to just write all that off on your taxes for this calendar year because December 1st was the start of your year. And you started thinking ahead about, okay, what is 2022 going to look like? What do I want my income to be? How much do I want to save? How much do I want to invest? Where do I want to be on my blueprint phases by, certain points throughout the year? By the end of 2022, where could I be on the blueprint, right? And so you're having those conversations, that vacation, that trip, whatever you're doing for the holiday season, A, you can enjoy it. B, it's exciting. And then C, it's tax deductible, which is, again, enjoyable and exciting. Okay. So that's the first thing. Now, December 31st, this is the one I want to stress at the risk of sounding mean. Okay. I'm not a very mean guy, but guys and gals, those of you that file your taxes on April 15th and you come to me and you come to your CPA and you're like, how do I reduce my tax bill? You like, that was the deadline for that was December 31st. You can't. If you're waiting till April 15th or you're waiting till the tax extension deadline where you're not even in April, you're now in October, which was today. And you're like, oh crap, my tax bill is more than I thought it was going to be. And I need to reduce it. And I need to lower it. The deadline for all of that stuff was December 31st. So when you come to us and you're like, hey, like I want to hire you to file my 2021 taxes and it's April 15th, 2021. And you're asking, what can I do to lower my tax bill? The answer is nothing other than putting some money in your retirement accounts, which isn't even like real tax planning. Like the life insurance salesman that you run into at your BNI group is going to tell you that. It doesn't take that much knowledge to figure that out. You can Google that stuff. That's the only thing you're going to be able to do. So if you want to reduce taxes, all of that has to be done by December 31st, right? Now, I want you to consider this. Your CPA, your tax person, your accountant, your estate planner, they all have families too. So they're going to take Christmas and they're going to take New Year's, which means that pretty much from December 15th onward, they're not going to be available. Right? Like we sometimes are. I remember on December what was it, 29th or 30th last year, I was on the phone with a client helping him get his 401k set up and funded, right? Because that's the kind of firm we are. We want to help out. But I'm telling you, that's not enjoyable for anybody. That's stressful for you. That's stressful for me. That's stressful for our CPAs. So everything is done end of year tax planning, tax reduction, December 31st, not April 15th, not October 15th. If you're waiting till then, it is too late. We're going to tell you that every single time. Should have done it by December 31st. Okay. Now we're in January 1st. New Year's happens. Boom. Had the party. It was great. New Year starts. And now we're all kind of ready to go, right? Not really. Usually that sluggishness from the holidays carries into like January 15th. But January 1st is now the start of a new tax year. And I want you to change your thinking on that, because we think about it's the start of a new calendar year. Yeah, it is. But really, what does that actually mean? It's the same thing every year. Think about this is now a new tax year, right? Which means 2021 tax year is done. Whatever I did by that deadline on December 31st is going on my tax return, aside from maxing out some retirement accounts if I want to do that before the deadline, right? But other than that, everything is said and done. Donations, trusts, accredited deals, depreciation schedules, all that stuff, whatever was said and done, spent, etc. Boom, that's no longer able to be done. Everything I do from this day forward is for the new tax year, right? So that's happening. The other thing that is happening is you should be doing your wage and your payroll adjustments. January 1st, you should be looking at that for the new tax year, right? And what I mean by that is if I'm a business owner, let's say that I own a corporation and I pay myself on a salary. Okay, I give myself a base salary and then I do distributions. Like January 1st, I should be looking at that salary because I already know what my tax liability is going to be for the prior year. I already know all that stuff. I did my bookkeeping, all that's there. So I should be looking at it and looking at, okay, do I need to adjust my wages at all? Do I need to change my withholdings? Do I need to have, less taxes taken out, more taxes taken out? Do I need to be paying myself less on my base or more on my base or whatever it might be based on my end of year statements from the ending year that just happened and my goal setting for the coming year? Right. So check this out. This would be an example of that. So let's say that I'm on phase 2 of the blueprint to financial freedom, and I'm on phase 2C, meaning I'm about to do a home equity line of credit. And I know that to do a home equity line of credit, I need to show a certain amount of taxable income, right? And so December 31st happens, boom, year's done. Let's say this is for 2021. So I know what I earned in 2021, and I can pretty much predict where I'm going to need to be at for 2022 if I want to qualify for a HELOC this year, which means I would need to adjust my wages to make sure that my income falls within that range. That would be an example. That would be an example of if I was maybe earning very little income and I needed to earn more, I would know that ahead of time and I would adjust my wages going into the year so that my income shows higher so that the banks accept and approve my loan, right? On the flip side, let's say that last year I paid a lot in payroll tax and I'm like, man, I didn't like that. I don't need to do a HELOC right now. I just need to pay less in taxes. Great. So January 1st, we would adjust your wages and payroll down so that you have less payroll tax coming out. Let's say you're a W-2, you're on a W-2 employee, you're hourly, your salary, whatever it might be, okay? And you got a tax return the prior year and we found that out. Or based on our end of year planning, we know that your taxes are going to be lower, okay? So based on that, you already know, okay, I need to reduce my withholdings. I don't want as much taken out of my paycheck because I don't want to get a refund. So my wages and payroll are going to happen at that point in time on January 1st. So all of this happens on January 1st. And a lot of people ignore this altogether. They never adjust their wages. They never adjust their payroll. If they do, it's at tax filing time and it's retroactive. And they're like, oh crap, I wish I paid myself less. Okay, this is how you be proactive with that, okay? So February 1st is our next deadline. This is where tax filing season officially begins, okay? So a lot of people are confused with tax filing seasons, right? So tax filing season and tax season. There's no such thing as tax season, right? There is tax filing season. There is tax planning season. They're two different things, but there's no such thing as just tax season. It's like this phrase I hear from people sometimes, are you going to do my taxes? What does that mean? What does it mean for me to do your taxes? Am I filing your taxes? Are we planning your taxes, for reduction or for income or whatever it is? Like there's no such thing as just tax season. So tax filing season begins February 1st. And that's where you file your taxes. You have until April 15th to do that, right? But again, we're filing them. We're not planning them. We're not trying to reduce them. Like all that should have happened already. Okay. So tax filing season begins. We're now into then March. March 15th, if we have S corporations, the deadline to either file our S corporation tax return or at least file an extension for it is March 15th. Okay. Now, to file an extension, this is going to sound brilliant. You actually have to file an extension, right? It's not like you can be like, okay, I'm just going to extend and do nothing. And then all of a sudden you magically get the extension. If you don't physically go fill out an extension, you didn't get one, which means if you now file after March 15th, you're going to have late penalties because you didn't file an extension. You actually have to file it, right? So there's a real form that you would fill out or your CPA would fill out saying, hey, we're going to be late. We're not going to file by the 15th. We're going to file instead before the extension deadline in September, but you actually have to send that in. A lot of people don't know that, right? So they'll think, okay, well, there's an extension deadline, which means it's just a grace period, which means if I don't file, I'm fine. No. If you don't do this, you will accrue a crap ton of penalties and it's not going to be fun. And if you try and apply for a waiver on the penalties, maybe you get it, maybe you don't, but it's still going to be taxing on your time and your money and it's going to be stressful, right? So March 15th, either file the S Corp or file the extension. April 1st, if you're over 70 and a half, right? So let's say you're older, you're in your 70s, 70 and a half comes around, your very first required minimum distribution on your retirement plans has to happen by April 1st on the very first year. So that means if you have a 401k or an IRA, right? When you turn 70 and a half, you are required to start taking income out of that. Even if you don't need it, the IRS wants to get their grubby hands on it. So they made a rule saying you have to start pulling money out. So when you turn 70 and a half, the very first year, by April 1st, you've got to take that first required minimum distribution. This might not apply to everyone, but all of us will eventually be 70 and a half at some point. If that rule is still in effect at that point, that's important to know. Because again, if you don't do it by then, there's penalties, right? You're going to find all the tax stuff that is here. All of the deadlines have some kind of penalty associated with missing it. Okay. So April 1st is that. April 15th, this is the big one everyone already knows about. April 15th, we've got to file our taxes. If we're on a regular tax return where we're just individual filers, we file what's called a 1040, which is just like your W-2. And if you've got some rental properties and self-employment expenses, all of that goes in your 1040. So that either has to be filed or the extension for it has to be filed. If you have a C corporation, you have to file your extension or file your return by April 15th. If you have a trust, you need to file your extension or your actual return by April 15th. Okay, this is the other deadline. If you're doing retirement accounts, you can actually back contribute. So you can back contribute into your retirement accounts, also into your health savings accounts for the prior tax year. So let's say it's April 15th of 2022, all the way up to April 15th, I can make contributions on behalf of 2021. Okay, so that's the one most tax professionals will tell you about. Like that's the go-to is like, hey, you can max out your IRA before the 15th. Aren't we brilliant? Okay, like you can do that. I don't like that. I would rather we just do it all by the 31st so you're done and it's a clean year, right? But you can, it's there, right? So April 15th, you can go do all that stuff. Now the next one is May 15th. In May on the 15th, you have your nonprofit filing date. So you either need to file your nonprofit tax return or file the extension for your nonprofit tax return. If you have a nonprofit, that applies to you. So again, if you're setting up charitable entities, some of you guys might be starting to get into that on like phase 4 of the blueprint here, right? You start doing like charitable trusts, charitable organizations, charitable entities. All of that stuff has to be filed by May 15th or the extension filed by it. Now, all of that is like the tax stuff. That's filing on time, either filing on time or extending. It's going to be February through May 15th, right? Now, after May 15th, this is where, if you're not already doing this, you should be doing your bookkeeping corrections. Okay, because you're now into 2022. It's May 15th. All the tax stuff for now is done. It's kind of something that's going to be a little bit of a breathing room. Look at your 2022 bookkeeping and accounting. But if you've not been doing bookkeeping and accounting, this is a great time to hire a CPA or a bookkeeper and say, hey, I want you to go back and I want you to get my books in order. Right? The bookkeeping is so important because when you get to the end of year planning stuff, which we're going to talk about in a little bit, if you don't have your bookkeeping, it's going to be very difficult for you to plan because you don't know what your numbers are. You don't want to be that person where it comes to planning season and it's like, great, I want to do tax planning. And it's like, great, well, what are your basic expenses? And you're like, I didn't think about that. Right? Like tax planning is not bookkeeping. Tax planning is where we take advanced strategies to reduce your tax bill, right? Tracking expenses is not an advanced strategy. That's like you should just do that. Like it's income minus expenses, addition and subtraction. Basic math. We learned that in second grade. Everyone should be doing that. So if you haven't been doing that, May 15th is when you should start thinking about this. Okay, I need to go talk to a bookkeeper. You can work with ours. We have a great bookkeeping firm and a team that I'm a partner in and owner in. And we can go back and look at, okay, since January 1st, what is it that you earned and spent with your business or your self-employment or your side hustle or your network marketing or whatever it might be, so that you're in present time on that stuff and you can just focus on now, okay, what do I do to lower my bill later on in the year? Okay, so all of this is May 15th. The next big deadline, this is July 31st. So July 31st, there's something called a Form 5500, right? So if you have a 401k, especially like a solo 401k where you're self-directing it, meaning you're putting it into like alternative assets and gold and silver and private lending, if your balance is greater than or equal to 250,000, you are required to file something called a Form 5500. This is basically a form where you certify with the IRS the value of the assets in your account. Okay, so you're telling them like, hey, I have a $250,000 account, and they want to make sure like, okay, are you tracking the growth? Is the compliance being kept up? Are you investing in assets that you're actually allowed to invest in? What do things look like? And they want to check it out, and they do that through this form. Okay, so to file this form, the deadline is July 31st. Right now, this would be for, again, someone that's on phase 4 of the blueprint to financial freedom. On phase 4, we start doing like tax reduction trusts. A 401k is a trust. Okay, that's all it is. It's a trust, and it qualifies under Internal Revenue Code 401k. And that's why we're able to use it the way we use it as. But with that being said, there's compliance attached to it. So we want to make sure that we do that 5500 form by July 31st. Otherwise, again, there are penalties. Okay, you're going to, again, see this over and over and over. The IRS makes up an arbitrary deadline, and then they penalize the hell out of you when you don't follow it. And this is not one that you're being advertised to about, right? You get advertised to about filing your W-2s and whatever, but no one is telling you on TV and social media like, hey, you're doing alternative investing in your 401k. Make sure you do your 5,500. Like that's not an ad you're ever going to see. So you want to know about this. Okay, now it's pretty quiet from July through September. Okay, now it doesn't mean you don't need to be doing anything. Like you still want to be keeping track of stuff. July is also kind of when the year is halfway through. This is a great time to review your goals because you set those in December of the prior year. Review them and see where you're at. Where's my income in relation to where I thought I was going to be at? What are my blueprint steps? What have I done? What's next? All of that stuff, you can kind of shore that up in July, right? Now in September, this is basically late season. So September 15th is the S-Corp filing deadline if you filed an extension. So again, the S-Corp filing deadline was March 15th. If you didn't file and instead you filed an extension, you need to file your return by this deadline, September 15th, right? Now, this also means that you can still do back contributions on those retirement plans for the prior tax year. You can do all of that up to the 15th as well. So if you want to do like a solo 401k contribution or a SEP or whatever it might be, you can do that up to September 15th. Okay. So that's an important one to know because again, a lot of people do extend. That's fine if you file an extension. That's fine if you file late, but make sure that you're paying attention to the deadlines because again, you want to turn all this stuff in on time. Okay. Now the steep part is if you file an extension and then you miss the September 15th deadline and you file late, you're paying penalties on everything from April. So it's not from September. It's okay. Would you now lose out on the entire extension window and you're going to pay penalties on every month since April 15th. Okay. Nobody wants to do that. Okay. So make sure you do that deadline by September 15th. Now the next deadline here is September 30th. If you have trusts. So let's say you had a trust. The deadline was April 15th, let's say for your trust, which was all the way up here, right? April 15th, trusts. You filed an extension. Okay, the deadline for trusts is it's 5.5 months after the extension was filed, which actually lands you on September 30th, which is different because if you look at this, it's going to say for your 1040 filing and your C Corp, which also the extension happened on April 15th. Those ones can all be filed by October 15th. So a lot of people might think, okay, well, I can file my trust. I'm good by October 15th. No. You need to file that by September 30th because it's 5.5 months after the extension was filed. That's your deadline. Okay. So again, September 30th is the trust deadline. Next deadline is October 1st. I told you guys there's a lot of these. October 1st. If you are an employer and you want to establish what's known as a safe harbor 401k plan. It's a type of 401k that has very lenient, non-discriminatory testing, means that if you're a high income earner, you can put in a lot of income into the 401k and there's no limits based on what all the other employees do. Some 401k plans aren't like that. They're going to be a traditional 401k where it says, hey, you might earn 300k and you might be able to put in, up to the limit, but because all of the other employers can't, all the other employees can't because their income is lower, you're limited based on the average of their contribution. So if your employer has a safe harbor 401k or wants to establish one, or you are an employer that wants to establish one so that your high income earners can put more money into the plan and it's not reliant on the average of what the other employees can afford to do, then you need to establish this by October 1st. Okay. So again, that's called a safe harbor 401k. So that's the establishment deadline. If you're an employer or have employees and you want to establish something called a simple IRA, the deadline for that is also October 1st. So these are both retirement plans, long story short, right? So these two types of retirement plans, if you want to do these, deadline is October 1st. Okay. Now, October 15th, this is actually today, right? So this is the deadline today. This happened at midnight tonight. The deadline's done. You're late if you're not in by then, right? This is your filing deadline if you filed an extension for your individual tax return, your 1040, or for your C corporation. Okay. So you need to get your filing done by today, October 15th, if you filed an extension for, again, your individual tax return, your 1040, or for your C corporation. Now, again, if you have retirement accounts like IRAs, 401ks, SEPs, simples that you want to contribute to, not establish, but contribute to, and they've already been set up before the deadline, then you can still put those back contributions in by October 15th as well. So that means like today, you could have put money into your 401k plan and had it apply to the 2021 tax year and reduce the tax bill, or to your SEP or whatever it would have been, right? So that's October 15th. Now, I don't necessarily like doing that. And the reason why is I find that people get confused, right? The 2021 tax year, again, ended on December 31st. But you're allowed to file these extensions. And so what happens is people will get confused that on October 15th, they're handling their 2021 taxes. That was last year. They'll get it confused with this year, right? So they'll forget, okay, October, I'm filing for last year, but in 2 months, I'm going to be doing this year. Okay, the year's going to wrap up and now I'm planning for 2022. Okay, so what ends up happening is some people will say, okay, well, all right, it's 2021, October 15th. I'm going to take a bunch of money. I'm going to throw it in my 401k. I'm going to lower my tax bill for last year, right? Now, the deadline is passed, good, but now it's planning season for 2021. And so if I threw all my money in my 401ks and stuff for last year, and I did that on October 15th, I might not have the cash for tax planning this year. See what I'm saying? So if I put 50 grand or whatever into my retirement accounts, I maxed everything out. That's dandy. That's awesome. But if that was my last 50 grand, then when it comes to reducing this year's tax bill, I'm not going to have the money to do it. Okay, so I don't actually recommend the extension game of filing an extension and contributing before the October deadline, because it always puts you running behind the game, right? Like I would rather you have all of your contributions and all of your planning, like I said, done by December 1st of the prior year, right? So if 2020 was ending, December 1st is when I would have made my 401k contribution. It's when I would have done all my planning and all my stuff to reduce that year's taxes, so that when 2021 rolls around and I'm in the new tax year, I'm not taking and stealing from my tax reduction on the next year. I'm in present time on everything, and any contributions I do, any planning I do is for the current tax year, and it reduces so much confusion because I see it happen so often where people are like, okay, great, we did the 401k, what's next? I'm like, okay, well, it's time to do the 401k again. That was last year. This is this year. And they're like, well, I don't have the money to, because we just put it all into last year's plan. So you have to almost break yourself out of that habit, because it's easier to file an extension and it's easier to do it all before the October deadline or the September deadline, but it does shoot you in the foot. Okay. And it does get confusing. So October 15th, we do all of that. October 15th is officially when tax planning season begins for the current tax year. Do you see how confusing that could be? You file your taxes. You're like, good, taxes are done. Well, no, now it's tax planning time. I thought we just did tax planning time. No, we just did tax filing for last year, we're now doing tax planning for this year. That can be very confusing, even though it's very simple and it's not super complex. People do get confused on it. So tax planning season begins October 15th. We basically carry that all the way through December 1st. Now, you could start it sooner. Let's say that you didn't need to file anything at all in October. You did it all by the September 15th deadline, or better yet, you did it all in April. Okay. Well, that means that you could start tax planning really at any point. You could start tax planning in September if you wanted to. You could do it in August, whenever you wanted to, because it's all taken care of. But again, if you're just now doing everything in October, it's kind of hard to plan for next year when we don't even know what happened last year. Okay. So tax planning starts now. With tax planning season, we cannot effectively reduce your taxes if we don't have you on a good payroll schedule. If we don't have a accurate bookkeeping schedule put together where we can actually see what are your profits and losses, right? If you're not presently, currently caught up on all your tax filings, it's very hard for us to do tax planning. So we want to have you on good payroll. Again, very beginning of the year, that should have happened. We reduced your wages or increased them or whatever. We adjusted your withholdings. We want to have you on good bookkeeping. Again, if you weren't doing that already, then after the May 15th deadline, you got on that, you got caught up, everything is good. You're in present time now, so that in October, you can hand us a year-to-date financial statement and say, here's what I'm on track to make. We can say, great, here's your tax liability. Based on that, we should do boom, 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 boom in order to reduce that. And this is what you would owe if you do all those things. Nice and easy, right? So that's all happening starting October 15th. Next deadline, November 1st. November 1st is the beginning of the open enrollment period for health insurance. So again, we're big believers in paying very little in health insurance premiums. We want to pay as little as possible. And so a lot of times you can't change your plan until open enrollment. And so November 1st would be open enrollment. And so what happens is people, they're late on their taxes. The October 15th happens. They're just happy to be done with it all. They're kind of annoyed that now we have to do tax planning season. Halloween is happening, Thanksgiving is happening, and open enrollment, they know it's there, but they're like, oh, I have until January to do it, right? Technically you do, but again, why would you do it late? Do it now, do it in November so that we can go into the new year knowing already, we can go into your planning period in December, knowing already what you have, how much it's going to cost, if you can do a health savings account, all of those things, right? And also, like, if you start in November with open enrollment, that means that your effective date, I believe, is going to be like January 1st. Right? If you enroll later, your effective date is later. So the rule is for health insurance, November 1st is the open enrollment. So go ahead and start doing it November 1st. There's no reason to wait and put it off. Next deadline is November 15th. So if you have a nonprofit and you filed an extension in May, right? It's now due in November. So November 15th, if you have a nonprofit, that's when you need to file your tax return for your nonprofit extension. I have a buddy last year, I spent a lot of time with them, and he has 90 something tax returns he has to file. And a great deal of them are nonprofits. Okay. And he filed an extension. And I can tell you the amount of stress that I've seen on a human being's face, bar none, what I saw in this guy's face, because November 15th, right before Thanksgiving and right before Christmas and all of these family stuff, and he has kids and a wife, he's sitting there banging through tax returns. Okay. Not fun. Right. So if you filed an extension, the deadline is here, but it doesn't mean you should wait till November. I think at the very latest, you should do all of this by October 15th. I think you should do it all on time, but if you do file the extension, do all of it by October 15th. So again, you can enjoy the rest of the year, because this is, again, that corridor of all these holidays and family events and get-togethers and vacations and travel and all of that stuff. Right. Now, next deadline is December 1st. And I know we covered this at the beginning. So the beginning of the year is December 1st. This is another December 1st. It's same December, but it's going to be at the end of this list, because if you want to do an HSA, so let's say in this year, 2021, I want to do a health savings account so I can put money into it and I can get a deduction on my 2021 taxes. Okay, if I want to do that, then by December 1st, I need to have enrolled in a qualifying high deductible health plan. Which means that, if I didn't have one already, if I did, this doesn't matter. Let's say I had one in January, I'm fine. I don't need to change anything. I can do an HSA. But let's say that I didn't. Let's say in 2021, from the beginning of the year all the way through till now, I did not have a qualifying health plan to be able to do an HSA, a health savings account. The rule is last month deadline. That's the rule. So if I enroll in a high deductible plan by the first day of the last month of the year, which is December 1st, then that qualifies me. Even if the prior 11 months, I had just a regular old health insurance plan or whatever it was. This is great because it coincides with that November 1st deadline. So let's say that I have an employer plan and I couldn't change it all year because I enrolled last November and that's what I'm stuck with until the new open enrollment period. And so now open enrollment is here. Okay, well, this says if I now do a high deductible plan, if I change my health insurance to high deductible so it qualifies, I have all the way up till December 1st to do that. And if I do that by December 1st, then I can go back and I can do HSA contributions for the entire year in arrears, even though I only had a qualifying plan for 1 month. Right? That's big. If I'm married, I think that's $6,000 I can put away tax deductible. If I'm single, I think that's $3,000 I can put away tax deductible. Okay. So that's something that excuse me, that's something that should not be overlooked, and it's something that should be known about and planned for. Now, the final one, again, December 31st, we talked about this at the beginning as well. Tax season ends. But again, if I am over 70 and a half, and I'm past my first year of RMDs. Remember, we said at the beginning, if I'm over 70 and a half and it's my first year, my RMD deadline was April. Well, if I've already done that, let's say it's my second year, I'm now 71 and a half, right? So my second year, third year, whatever, the new RMD deadline at that point, recurringly on a regular basis, is December 31st. So I've got to take my required minimum distributions by December 31st. Now, granted, if you have a good CPA, this should be part of your tax plan. Right? Like, we should be thinking about, okay, you're going to pull out RMDs, you're going to owe taxes on them. How do we mitigate that? That should be a conversation we're having during tax planning season in October. And so all of that should have happened already, right? Remember, I said my rule is I want all this stuff done by December 1st because I don't want to hassle with this on Christmas and New Year's and all that. But it's hard enough as it is. It doesn't need to be more difficult, right? So all the way from the year, from December to December, these are all of the main basic deadlines. And I want to count them up. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. I mean, that's more holidays than I celebrate, right? I celebrate what? Maybe half a dozen holidays. Probably you guys do too. If I include important birthdays, I may be celebrating 10 things a year. This is more than that. I just counted 13 of them, right? There's probably even more than what I have on the list. These are just the basics. So my point tonight is, like, between birthdays and holidays, is 10 things that I remember every single year because I have to buy someone a present, or I have to show up to a party, or, culturally it's frowned upon if I don't remember it. I'm telling you guys, these are like 13 to 15 things that if you don't remember, there is a financial consequence. And that consequence is not just a penalty. Like, yeah, sure, a lot of these do have a penalty, but the consequence is you're not making progress if you don't remember these dates. Right? Like, if I'm not keeping in mind the tax planning deadline is October 15th, that's when tax planning starts, and I don't have that in my head, the penalty is I don't do tax planning. And I'm going to pay more in taxes, which means I keep less of my income, which means I invest less in my income, which means I have less passive income, which means it takes me longer to get financially independent if I ever do at all. That's worse than any penalty the government could impose on me. Right? And it's also more important than a Christmas present or a birthday present or a party or social acceptance. Okay. So these are all things that, again, like, I don't expect you guys to remember all these tonight. I do expect that you wrote them down, or you pay attention to them, or you're going to go back and watch these and make sure they're in your calendar or in your journal or your planner or whatever it is you use, because this is the start to taking control of our finances. This is the start to remembering what are the dates, staying on track with things, staying in line with things, right? Now, I want to talk really quickly before we answer questions. Again, if you have questions, drop them in the comments. Questions can be things I said that you didn't understand, right? Like, and I want to use this quick example. Not understanding something is like wetting your pants, right? There's two kinds of people when it comes to wetting their pants, right? I'm going to say three. We'll change that. There's three kind of people. There's the kind that don't, right? Which is likened to, they don't misunderstand things. When something happens and they know they have to go to the bathroom, or they know there's a word or a concept that they didn't get, they handle it right then and there. They go to the bathroom, in the toilet, not in their pants. Okay. There's the kind that they know they're about to wet their pants, or they just did, and they say something immediately. That's group number two, right? Like, I wet my pants. Oh, I'm going to make sure that, my parents, I'm going to handle it. I'm going to get it cleaned up. Okay. I misunderstood a word. I misunderstood a concept. I'm now not interested in the course, or I glazed over, I'm yawning, whatever it might be. I feel sleepy. I'm going to speak up and ask a question. And then there's the third group. Okay. The third group just sits in it. They wet their pants. They don't tell anyone. They still go play with their friends. They reek the entire time, right? They still get in bed and cuddle with mom and dad and get the pee all over the blankets, right? This is the person that misunderstands a word or a concept and they say nothing. They just stew in it. They just goes right over their head and they start yawning and getting bored and then blah, 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 and all this stuff's happening. So again, if you misunderstood something, be the first group and the second group. Ask a question. If it already happened, be like, hey, I didn't understand when you went over X, Y, and Z. What did that mean? I just wet my pants. Let's get it cleaned up. Or I already checked it out. I was preventative about it. But don't be the third group where you're like, that didn't make sense. I don't care. I'm too lazy. I'm not going to ask any questions. Okay. So ask questions, drop them in the chat because we're going to hit questions in a little while. So there can be things you didn't understand, things you have questions on regarding application. How do I apply this? Maybe scenarios that you want to run by this, obstacles that you might see with this. Like lots of things could be questions, but I want to encourage you to ask those questions. Now, before we jump into questions, let's talk about the pitfalls here. What are the things that are pitfalls? What are the things that could prevent someone from doing this? Number one, not actually marking calendar reminders, right? Acting like it's someone else's job or that someone else is going to take care of it or it's not a big deal. And so I don't, whatever the reason would be, so I don't set calendar reminders for any of these dates. That would be a pitfall. That would prevent me from actually meeting these deadlines and being proactive. And either I'm going to be reactive or I'm going to be a dead body where I don't do anything at all. And I miss the deadlines and I have penalties and I'm back on my taxes or I've never done any planning or whatever it might be. Okay. So that's the first pitfall that we want to avoid. The second one is procrastination, right? This is, okay, the deadline is October 15th to file my tax return because I did an extension and it's August and I could file it now, but no, I'm going to wait because it's October 15th and now it's September and I could file, but no, I'm going to wait. And then October 10th, you're like, hey, I need to file my taxes. And now it's an emergency because you waited till the 10th. Okay. My dad told me this: lack of planning on your part does not make an emergency on my part. Do not procrastinate. Get this stuff done, right? A versus Parkinson law, where it's perfectly true. The work expands to the amount of time you give it. If you give yourself 2 days to get it done, you're going to take 2 days to get it done. If you get it done immediately, no lag, and you just handle it, then you don't have to worry about it, right? And a lot of the emergencies that happen, especially with tax season and filing and planning, are simply because of procrastination. Okay. It's like last minute Christmas shopping. And here's the thing is our CPAs, they know the deadline. They know you knew the deadline. And so when you come to us and you're like, hey, it's the 10th, I need my stuff filed and it's due in 5 days. Not cool. Like we definitely are looking at that and we're like, man, this person just procrastinated the entire year and now it's an emergency, right? So do that stuff ahead of time. Next one is confusing the current year with the prior year. I mentioned this earlier, right? I wait till the extension deadlines and then I get confused with the fact that on the extension date, I'm filing for last, right? And really I should be filing for this. Ooh, let me fix my screen here. Really I should be filing for this year, not last year. And that's the mindset that people get caught up in and confused with. Okay. Hey, Lexi, could you figure out the TV for me? I'm not quite sure what happened here. So that's the mindset that people get confused with. Oh, we're back. Cool. We're back. That's the mindset people get confused with. And the way to correct that is stop doing the late game. Stop doing the extension. Stop filing late. Always file on time. Do your planning before December 1st. Get everything done before December 31st. And then you're always doing it when it's supposed to be done. And then there's no way you can get confused, right? The other pitfall is missing the extension dates. I talked about this earlier, right? Thinking that the extension is just like a grace period and you don't have to file anything and you're automatically granted. No, you do have to file, right? Who's ever seen that show, The Office? Who's seen The Office before? I love that show. There's an episode where the main guy, Michael, he's like behind on his bills. He's in massive debt and he decides he needs to file for bankruptcy or declare bankruptcy. And he thinks it's just the thing you declare, right? And so he marches out in the office and he's like, I declare bankruptcy. And nothing happens because that's not how it works. It's paperwork. And everyone's like, you can't just declare bankruptcy and expect it to happen. Same with tax extensions. You can't just extend your taxes and expect that you're okay. No, you do have to file a form and fill something out. And then the last one is the mindset of ignorance is bliss. This is the person that looks at this list and they can't confront it. They're like, there's so many dates and so many deadlines and so many things. And so instead of, increasing my responsibility level and handling it, I'm actually going to shrink back and pretend I didn't hear any of it. And then I'm going to ignore it. And then it's just going to be fine because it never happened. The equivalent of wetting your pants and then just sitting in there in it, Okay. But the thing is guys, these deadlines, whether you're aware of them or not, whether you're ignorant of them or not, they're happening and they apply to you. And if you miss them, there are consequences, both in the form of penalties and in the form of opportunity cost. And you will pay those penalties, whether you're aware of it or not. Right. And so if you want to be, again, high responsibility, winning with finances, creating financial freedom, building wealth, you can't live in the world of ignorance is bliss. Ignorance is not bliss. Ignorance is a liability. Ignorance is danger. Ignorance is treason to yourself. Right? Because the truth is there's no such thing as ignorance. We already know. We're pretending we don't know because it's more comfortable and it's easier to pretend we don't know. Okay. So what I want to do is I want to open this up for questions for action plan, which I usually cover. The action plan is pretty simple to start. Like, look at the dates, rewatch this, screenshot it, whatever you need to do in order to make sure you're keeping up on this. If you're not working with a CPA, work with our firm. We will help you with these things. As long as you're being proactive, things will be fine. And it's very easy. Okay. No different than adding a couple extra holidays. Like, you'd add them to your calendar just like you would a birthday or a holiday or a day off or a vacation. Right. But again, the flow of this is that at the end of the current year, we're already wrapping up our planning to reduce the current year taxes. And at the end of the current year, we're already planning for next year. At the beginning of next year, we're adjusting our wages so that we can, make sure that they are where they need to be at. We're adjusting and correcting our bookkeeping to make sure it's accurate so that we can file things on time and plan things on time for the next year. And it continues to happen in that cycle over and over and over. And at the beginning of this, I said repetition is certainty. Repetition and action is too. The first year you do this, it may be, difficult, and it might be something that's maybe cumbersome and complicated. But the more you do this and the more years you do it, you're going to start getting down and it becomes routine, right? Like, I imagine it's probably like this when you have kids. You have a bunch of kids. Now there's a bunch of new birthdays and names you have to remember. If you have, a bunch of kids, initially it might be hard to remember, like, oh, that's the day he was born, right? After a couple of years, you figure it out. You're like, aha, I know that one's name and his birthday, right? So I want to open this up for questions. If you have questions, drop them in the comments on Facebook, on Zoom. Let me jump on Facebook first. Good to see everyone. Again, if this was something that was helpful to you, please share it. Get the word out. Jaswan, good to see you. Sean, good to see you. Pharaoh, good to see you. Reggie, good to see you. I do not see questions on Facebook. I think I do see some here on Zoom, though. Awesome to see everyone on Zoom as well. Mark asks, how do I get the end the Fed mug? Mark, this is actually from Mises Institute. So if you go to Mises.org, okay, they're a nonprofit, Austrian economic group. They're anti-Keynesian, and so you can buy the end the Fed mug there. Do you buy them, Lexi, or is it by donation?
You can do both, I believe, but I believe you have to buy it initially.
Okay, so you can buy or donate, but go to the Mises Institute, Mises.org, and you can find mugs like this. Okay, we have a couple questions from Nano here. Let me go ahead and bring Nano on live. How are you tonight, Nano?
Doing great, man. And you?
I'm good. Thanks for asking. You got a couple of questions. Let's go ahead and start with the first one.
Okay, cool. So what's applicable when it comes to the tax planning to a person who has not passed their phase 2 on the blueprint plan?
Yeah, so that's a good question. So Nano is pointing out on the blueprint. So there's 6 main phases here, from 0 basically being financially illiterate all the way up to becoming financially independent. On phase 2D to be specific, we start doing what's called advanced tax planning. And the reason why we do that in phase 2 is because prior to phase 2, people typically still have consumer debt. They typically don't have their reserves built up. They typically have things that if they didn't cover, that would be a financial liability to them and cause them to be insolvent. And so after all that's handled by phase 2, that's when we start having money to allocate towards advanced tax planning. Prior to that, let's say we were like, hey, let's have you throw, 40 grand in your 401k plan. Awesome. We just reduced your tax bill. But let's say you also had 100K in consumer debt, and that 40K could have knocked out your consumer debt by half. Smarter to put it towards the consumer debt than the 401k there. So prior to phase 2, to answer Nano's question, the very first thing is what I call living in your business, right? And what this has to do with is it has to do with taking all of your existing expenses, things you already spend money on, and thinking about, okay, how do I involve this with my business? Right. And the reason why is these things often become tax deductible. There's three things you have to look at there: intention, facts, and circumstances, right? Intention, I have to have the intention that this thing actually would be for business. The actual facts, meaning I'm documenting it, whether it's an expense or mileage or whatever it might be. And then circumstances, making sure it's an acceptable circumstance to be using it for business. As long as I do that, I can write off things like office space, transportation costs, meals, different things that, travel, vacations. So those are things we'd look at. So that's the first one, Nano. And that's kind of on like the bookkeeping or the accounting realm. And that's where you can have apps like, our Keeper Tax app, the tax app that Nano you're using, our bookkeeping services. Those can all help someone do that. But that's kind of the first layer of that. The second layer would be incorporating. Let's say, you have a self-employment venture or a business. You're now making, $100,000 in revenue. And so now we would actually turn you into an S corporation so you can reduce your self-employment tax. The reason why is the expense thing and the incorporation thing, those are virtually free. Like, other than the expense of doing the transaction itself, you're not having to push a bunch of money into it like you would, whether it's a 401k or an oil and gas investment or real estate. It doesn't require capital. It's just a change in structure and accounting. And so that helps you reduce your tax bill. So it's kind of things along those lines. So those are the first two that I would suggest, Nano. There are a couple other ones, but those are the main ones.
Okay, thank you. And once the person that is past that phase, then what will be considered at that point for the person to be doing?
Once they're in phase two?
Well, I guess past phase two, right? Phase 2D.
Yeah. So that's a good question as well. When someone's past phase two, they're in phase 2D. There's a ton of stuff you can do. And I won't go over all of the names and stuff because it's distracting and it's a lot of then having to explain what they mean. But to give you an example, if someone is on phase 2D, it's very real that we can reduce their tax liability down to zero or close to it, right? Because at that point, the plethora of options we have for tax reduction are very vast. And then the amount of capital or money that person has to direct to those vehicles, because it's not having to go to debt, it's not having to go to reserves, it's not having to go to all this other stuff they used to have to spend on. It's now available to start pushing into these different tools that we'd use for tax reduction. So there's a lot that you're able to do at that point. I won't get into the specifics of it tonight, but we can easily reduce the tax liability very close to zero or down to it if someone really wanted to.
Okay, thank you. And my last question is, what is considered to be high earner to be put it? You said there was a specific 401k for high earners to be putting their money on. What is it considered to be high earner, and what does that entail?
Yeah, so there's not a hard and fast definition of that. It really has to do with the contribution level. So if I'm trying to max out my 401k and get all my company profit sharing, and I think the limit of doing that is like 57,000. If I have enough money to do that, let's say that my income is like 200 grand and I've got enough money to do that. If I'm in just a traditional 401k plan, and this is for a company that has a bunch of employees, right? If I'm in a traditional 401k plan, I would be limited, right? The IRS would say, hey, because all of the other employees can't afford to put in that much, you're limited to the average of what they can do. And that kind of limits me on being able to put money into that plan. So you could call that maybe, like 150 or 200, I'm sure, is the range where the average person has enough money where that matters, enough income to be specific where that matters. And again, the plan for that is called a safe harbor 401k versus just like a traditional 401k plan.
Okay, thank you. Would the individual be doing the self-directed at that point to then have access to it later as an accredited investor?
They definitely could. Yeah. There's a lot that goes into like the company structure and how much control they have. If it's a solopreneur, like a business owner that doesn't have employees, then they can just do a solo 401k and self-directed. If it's a group plan, then it becomes more complex. You still can self-direct it if you set the plan up correctly, but there's a lot more hoops to jump through. And it's also, again, a lot more restriction based on the income level and also the financial literacy level of all of the other employees. So it can be done, but it just takes some planning and some work. And in some cases, it doesn't make sense because of those factors.
Okay, awesome. Thank you.
Awesome. Good questions. We have a question here. How do I move myself from an income statement to a balance sheet? So I don't quite understand the question. You usually will always have two of them. You'll have always an income state and always a balance sheet. An income statement is going to be, again, your cash flow, income minus expenses. Balance sheet is going to be assets minus liabilities. You pretty much will always have each of those things. You'll always have income and expenses, and you're always going to have assets and liabilities. So I don't think you're going to move from one to the other. You might move to where your income comes more from the assets, but the idea of having, just a balance sheet and no income is probably not real. You'll still have income coming from somewhere. Good. I think we have all of our questions answered. David says the deadline IRS list made his day. One of his courses, he failed because of missing the deadline. That's good. Yeah. And again, David, rewatch this if you want to get all the deadlines down, but that's definitely a good thing to pay attention to and to have in your calendar there. Let me see if we have any other questions on Facebook. And if not, we will wrap this thing up for tonight. Good. Yeah, I think that covers everything. Nano asks, will you be sending the deadlines out by chance to everyone? Not specifically. The video replay will be available. So if you want to go back through it, you can. We don't have a list to send out though on this. So we'll send out the video, and then your job can be to make sure you get all the deadlines, or at least screenshot the spot in the video so you have them there. So good. I think that's all of our questions that I see for tonight. What I want to do is, again, if you guys are new to this and you have not grabbed a copy of my book, go to jerryfetta.com/B2F. That's the letter B, the number 2, the letter F, Blueprint to Financial Freedom. This is the book that I wrote on the blueprint I've followed and organized based on studying the top 1% of wealth to become financially independent. Again, passive income greater than savings, expenses, and taxes. So if you have not gotten a copy of it, again, that's jerryfetta.com/B2F. Other than that, we will be back again next week. Have a great weekend. I'll talk to you guys all soon.